Welcome to This Explainer. For the last 15 years, our entire economy has essentially been built on a single, totally unwavering foundation, and that is free money. Homes got super expensive because borrowing cost next to nothing, and stocks? Well, they soared because honestly, where else were you going to put your cash? But right now, we're witnessing a massive, violent reversal of all of that. That whole era of free money is abruptly ending, and the financial system is scrambling to adjust. So today, we're going to unpack exactly what's happening, why the numbers are suddenly flashing red, and how this whole thing ripples through everything from Wall Street directly to your own wallet.
Okay, let's dive into this. We're going to break this huge macroeconomic shift down into 5 clear steps. First up, the 5% shock. Second, unpacking bond market mechanics. Third, the forces driving these yields higher. Fourth, the economic ripple effect. And finally, navigating the new normal.
Starting right off with part 1, the 5% shock, and the end of a 15-year era.
Our source issues a pretty dramatic warning right out of the gate here. They describe our current reality as a world where the safest investments in America become the biggest threat to everything else. Counterintuitive, right? But think about it for a second. When the payout for guaranteed, rock-solid safety goes up, the incentive for people to actually go out and take risks, things like starting a business or buying real estate, well, that incentive completely plummets.
And honestly, the whole shebang really comes down to this one number, 5%. For the first time since the 2007 Great Financial Crisis, Treasury bond yields actually breached this magic threshold. And this isn't just a random number. It's really the first major domino to fall, and it's forcing the entire economy to completely recalculate its math.
Now, what's really interesting about this is how it all works under the hood. Let's move to part 2, unpacking bond market mechanics and the seesaw effect.
Just as a super quick refresher, a Treasury bond is basically viewed as the ultimate risk-free rate of return. You lend the U.S. government money, they pay you a fixed rate, and eventually they return your principal. Because the government realistically isn't going to default on that, it's traditionally seen as the absolute safest place on earth to park your capital.
But, and this is absolutely crucial, we've got to remember the seesaw relationship here. Bond prices and bond yields always move in exact opposite directions. So high demand pushes bond prices up and the yields down. But when investors start selling them off, the prices drop and the yields spike right up. Let's put some quick numbers to this just to make it a bit more concrete. Let's say our baseline is a $100 bond that pays out $5. That is a solid 5% return. Now, if everyone suddenly wants it, the price of that bond might rise to $125, but it still only pays that same $5. So your actual return drops to 4%. Make sense? On the flip side, if demand totally tanks, the price might fall to $80. You pay $80 to get that same $5 payout, and suddenly your yield spikes up to 6.25%. So when you see headlines screaming about spiking yields, they're really just reporting a massive sell-off of government debt.
All right, let's zoom out to the macroeconomic level for part 3, forces driving yields higher and the 3 macro fuels behind them. So why are investors demanding higher returns right now? Well, 3 huge forces are hitting the market literally all at once. First up, we've got stubborn inflation. Recent data showed the CPI jumped 3.8% year over year, and wholesale inflation hit 6%. Second is oil. Geopolitical conflict in the Middle East has pushed prices past $100 a barrel, and expensive oil, that bleeds into absolutely everything: shipping, manufacturing, your groceries. And the third force, the U.S. government itself, is just flooding the market with debt.
Which brings us to this staggering figure, $2 trillion. The U.S. is currently running a $2 trillion annual deficit. That means the Treasury is essentially passing around a giant collection plate to raise cash. But the buyers? They're stepping back. Even Japan, who holds $1.2 trillion in U.S. debt, is buying less because their own yields are up. So you have high supply and low demand. Yields absolutely have to rise to attract any buyers.
To put that into perspective, let's ground this in a bit of history. During the 1994 Great Bond Disaster, yields spiked over 8%, literally wiping out $1 trillion. Fast forward to the 2023 banking crisis, the 10-year yield passed 5% and bank stocks plummeted by 50%. See, historically, 5% acted as a ceiling. Markets would panic, and then yields would eventually drop back down. But the terrifying question today is, what if 5% is no longer a ceiling, but actually the new permanent floor?
And this brilliantly illustrates our next section, part 4, the economic ripple effect and the 4 falling dominoes.
Because this 5% threshold was crossed, we can basically categorize the fallout into 4 major falling dominoes. A government debt spiral, serious pressure on the stock market, a completely frozen housing market, and a much broader corporate slowdown.
So let's look at how this plays out in real time across these sectors. First, the government is already paying over $1 trillion a year just in interest alone. Higher yields widen that deficit, which demands more borrowing, which pushes rates even higher. It's a vicious spiral. Second, stocks. I mean, if you can get a guaranteed 5% for doing absolutely nothing, those volatile high-growth tech stocks look way less appealing, right? Third, housing is basically frozen. If you're locked into a 3% mortgage, there is no way you're moving to take on a 7% one, which kills inventory. And finally, corporate growth stalls. Higher borrowing costs mean companies just delay their investments and freeze their hiring. The economy doesn't break overnight here. It just sort of slowly grinds to a suffocating halt.
Which brings us right into Part 5, navigating the new normal, and what this actually means for you.
Zooming back into the micro level, for everyday investors, it really comes down to two very different strategies right now. On one hand, short-term treasuries are offering this beautiful, safe 5% yield. It's fantastic for preserving cash, but you've got to remember, treasuries are for preservation, they are not for growth. Over a 10 to 20-year horizon, that 5% safety net risks being completely eaten alive by inflation. Historically, the stock market offers higher returns because it compensates you for taking on risk, and that risk is exactly what's required to build actual long-term wealth.
Now, overseeing this entire balancing act is the Federal Reserve, and man, they are caught in a massive trap. It's a classic catch-22. As the system readjusts to these interest rates staying higher for much longer, the Fed has to walk an incredible tightrope. If they step in too soon and lower rates, they risk letting inflation just run completely out of control. But if they wait too long and keep rates high, they risk doing severe, lasting damage to the broader economy.
So, the era of free money? Yeah, that's firmly in the rearview mirror. As we've seen, the biggest risk right now isn't necessarily an overnight crash, but a slow, steady constriction of the entire financial system, which leaves us to ponder one ultimate question. In this new era, will 5% actually become the economy's new floor? It's a shift that could literally define the next decade of wealth. Thank you so much for joining me on this explainer today, and whatever you do, keep your eyes on those yields.